That sense of deja vu, and thank you, Jonathan. I mean, after an intro like that, it can only really be downhill. But good afternoon, Manchester. It is that graveyard slot, and like Trevor, we want to keep you alive and awake. I'm delighted to be back here again. And I think, I must say, Trevor, if your surgeon likes operating on economists, then he's going to love consultants, because there are probably quite a few of you who think we only have one moving body part, and it isn't our mouths. Anyway, I do have slides. I do have notes, and I do have some facts, so hopefully we'll try and mix that up. And in true sort of presentation style, to give you an idea of what's heading your way, I'm going to give you a rundown of the UK market. First of all, I'm going to show where we've been to put that recent performance into context. And we'll cover current hotel operating performance, and then we'll take a look at the all-important development pipeline. Now, it's a team effort to produce this presentation. I'm fortunate to be able to draw on a great team in that respect. So in addition to the 10 or so CBRE Hotels folk amongst you today, I'll be calling on a few other CBRE friends during this presentation remotely to share their particular insights with you and to spare you the monotony of having to listen to me alone for the next 30 minutes or so. And I'll finish up by sharing some of my thoughts for the future. Now, for those of you that were here last year, you'll recall that sort of multimedia journey that I took you on to show you how the provincial and London hotel markets had performed through the cycle from 2008 to give you a sense of context and evolution of room occupancy on the left-hand y-axis and average room rate on the right-hand axis. Now, as you'll all know by now, green is good. I would say that from CBRE. And where you see green, that equates to RevPAR growth and the direction of travel and what I'm about to show you. Red is bad and reflects RevPAR decline, and orange indicates RevPAR recovery. Now, because some of you were here last year and saw it, I don't want you sitting there thinking, oh, I'm going to see that presentation again. It's going to go fast forward. Hopefully it'll wake you up a bit, and it'll pause momentarily so that you can see what the sort of travel of performance has been since this time last year. So, let's start with regional UK. Ooh, no sound. Let's go back. How's that? So I'm glad to say it's all been green and good, really, after what have been some pretty tumultuous events over the last 12 months. We've seen continued RevPAR since last year's conference, and that's been largely driven by rate, which now sits at about £81 in comparison to just about £78 back in August, and that's up by around 4%. Now, occupancy levels have grown too, a state of affairs which is expected to be maintained if Britain continues the staycation trend post-referendum. And an average occupancy sits at around 75.2% in the 12 months rolling to August, and that's in comparison to 74.8% to the 12 months to August 2015. It's worth noting that year to date there's been a net increase in supply of 5,500 rooms, which makes these gains, I think, all the more admirable. We should also remember that this data excludes budget hotels. It also excludes Airbnb. Now, whilst what's going on in the Airbnb arena is relatively opaque, we can obviously dive into the budget market. In the regions, about 151,000 budget hotel rooms in the regions, about 24% of supply. It's expanded by about 3%. And over the last 12 months, they've achieved occupancy of 76%, which is down nearly a percentage point, an average rate of £55, down nearly 5%, a RevPAR £43, just up 4%. I think the gap between provincial hotel occupancy rates and that of London hotels is probably at its narrowest ever. I think that's brought about by some pretty stellar provincial occupancy, looking at these figures, and a somewhat muted London, to where we'll now turn our attention. So sadly, both Prince and David Bowie are no longer with us, but we thought it was right to include those tracks. Right, well, you notice the difference in scale between the regional UK and London. Performance, as you would expect, is at a higher tempo where we can see higher occupancy levels and obviously much higher average room rates. Performance has been rather subdued in the capital, though, since the beginning of this year, and that's been reflected in the declines in occupancy levels. Over the summer, RevPAR improvement was mainly driven by a slight upswing in average rate, and it'll be interesting to see how London's average rate plays out, I think, for the remainder of the year. As typically, London has a strong second half. Last year, 54% of rooms revenue were generated in the back end of the year. Average occupancy currently sits at 80.6%, 12 months to August. Rate is up by just shy of 3% at £154 in the 12 months. And as with the earlier provincial analysis, this is for full-service hotels only and excludes budget hotels. There are 29,000 budget rooms, about 20% of the supply in the capital, and these have increased in number by 5% or so this year. So the sector has done, and I think and will continue to, the budget sector that is, deliver significant additions to London's supply. And they will almost certainly have been having an impact in terms of soaking up the more price-sensitive demand that was previously accommodated in the full-service space, I think thereby reducing volume but leaving higher-rated business behind. Over the last 12 months to August, budget hotels have achieved 83%. That's down a couple of points on last year, an average rate of £79, up by 0.3%. And that rate they achieve is within £2 of the provincial full-service hotel average. And statistics suggest there are currently 43,000 Airbnb listings in London, which will be impacting the market, both in terms of capacity, but also, and perhaps picking up on Thomas's earlier presentation, they will be increasing competitive tension and driving change by those that are embracing it. At a macro level, according to the IPS survey, in the rolling 12 to July, London attracted total visits of 36.6 million, up 4%, spending 22 billion, just down by 1% year on year. I think the best way to sum up London hotel market performance at the moment is that whilst it remains a phenomenal hotel market, I think it is labouring a little under the sheer weight of supply that is coming online. So continuing with the where we are, let's take a look at more recent performance broken down into some key UK markets. What we're showing here is occupancy and rate for the year-to-date 2016 and the year-on-year change in those metrics. It's a largely positive picture if we look at occupancy and rate across the UK markets that are shown here. Now, of course, Aberdeen is shown up in stark contrast to the rest of the market, so we'll remove it to take a closer look at those other UK locations. Growth in ADR has outpaced the growth in occupancy, with provincial hotels operating at such a high occupancy. I think it's resulting in peak demand on selected nights being experienced frequently, and that's giving a clear revenue management opportunity for the astute operators out there. But a pretty positive picture, I think you'll agree. If we now move to look beyond RevPAR and to take in TrevPAR, that's total revenue per available room, and GOTPAR, gross operating profit, so after all those operating costs have been taken account of, for 12 months to August, again we see the year-on-year change. Now, there are no real revenue or profit statistics for the budget sector due to their limited service operations. Now, Aberdeen there, I mean, it really is, sadly, a special case, if not a basket case just now. I mean, in 2014, that market was peaking in terms of RevPAR, and comparing that high peak to trough at the moment in 2016, RevPAR was £79 back then, it's £45 today. Rates back 26%, and profit is down nearly 50% per occupied room. So it really needs new supply like the proverbial hole in the head, and if only that were the case. But once again, we'll remove Aberdeen to make for easier viewing of the others. In Birmingham, RevPAR has been strong, up 7.5% nearly, profitability up 5%. Fundamentally, Birmingham is a good market. Its underlying demand growth has been strong through the cycle. It's just that too much supply, and big lumpy supply at that, has been lobbed into it. Glasgow still wearing off its Commonwealth Games hangover. Last year I showed more impressive figures on the back of those, where RevPAR was up 4% at the time of last year's conference. This year, RevPAR is just up by over, just by 0.2%, while profitability is down. London, Year to date, RevPAR is down by 0.7% as a result of that sliding occupancy, while rate is up by 1% for the city as a whole. The luxury segment currently shows a slightly better picture, where ADR is up by nearly 1% and occupancy up by 1.2 percentage points, resulting in a RevPAR up by about 2.5% nearly. Nonetheless, TrevPAR and GOTPAR are down year to date, and that is arising largely from increasing costs of sales. But demand continues to grow for London hotels. However, the high supply growth, I think, is undermining this in performance terms. So to turn to where we're going, we now need to look at the supply side of the equation. And as ever, I'm indebted to the peerless AM/PM hotel supply data here. So thank you, Alan, wherever you're lurking in the audience. If we look at regional supply pipeline, what we're showing here is the historic additions, the percentage changes. You can see the dotted line average and the year-on-year growth there, and we're breaking that out by the different segments. And confirmed pipeline are those projects that have an opening date in Alan's database of either this year, 2017, or 18. The annual net supply increase long-run average is 1.5%. And last year, we expected this year to finish off with about a plus 3% increase, whilst only, I think, 2% is likely to be realized. If we look at 2017, though, we're looking at a record-breaking forecasted provincial supply growth of 3%, which would outpace the previous supply growth since 2000. And we're talking about a near 20,000 rooms coming online in 2017. So all that strong performance that you saw in the earlier slide is translating into an equally strong development pipeline. After an expected strong year in 2017, the confirmed pipeline for 2018 is not that significant yet, but we do tend to see project slippage because we all have very ambitious expectations as to when our projects will open. So let's just now dip into some key cities to give you some context there. Edinburgh's looking like receiving a 13% rise in supply. That's the highest in actual room terms. That equates to about 2,350 rooms. Belfast will have a 25% increase, highest proportionate increase, but that's about 1,150 rooms. We'll see a luxury hotel in the Titanic Quarter there, the Harland and Wolff offices. Aberdeen, though, 17% supply heading its way increase. So, I mean, it really does, as I say, need that like the proverbial hole in the head just now. Now we're going to see the Hilton Aberdeen Exhibition and Conference Centre with 200 rooms coming online in 2019. But the less said, the better, probably. Leeds, up 9%. Another Hilton, the Hilton Leeds Arena in 2017. Liverpool, we're going to see 5%. The Martins Building, Principal Hayley, 227 rooms due in 2018. That'll be a sister hotel to the Principal Manchester. That spectacular conversion that Principal Hayley and Starwood Capital have put into that asset. Manchester up 9%. We're seeing over 2,000 rooms with those opening dates in the budget and upscale segments. We have Motel One debuting here next year. We've got Crown Plaza with 210 rooms in 2017. We've got a Hilton Garden in Emirates, Old Trafford. Not sure which. Stock Exchange Building, GG Hospitality, the guys on Hotel Football, they're looking at doing something new there. So a lot happening in this particular city. If we now jump to London, same way of measuring it, giving you an idea of the makeup of that supply over recent years. The long-run average there is 3%. In this time last year, we expected the year to finish with a plus 4% increase. And it's looking like it will be that. 2017, another 5% increase in supply. 2018. So, you can see when you look at that right-hand side, we are perhaps adjusting to a new normal of supply addition. And that is going to maintain pressure on the London market. But then equally, London, if there's any market that's going to benefit from a weak sterling, London certainly will from a leisure visitation perspective. If we look at the pipeline as to where that is concentrated, I think there is an inexorable movement eastwards, which is apparent in this graphic, where you can see significant pipeline, and you can see perhaps insignificant pipeline in somewhere like Kensington and Chelsea. But Haringey is going to have a 100% increase, albeit from a low base. Hackney, home of trendy Shoreditch, is going to see a Nobu Hotel debut, the Curtin Hotel Private Members Club, the Highgate Shoreditch, Tune Hotel will go there. City of London's going to see a 29% increase with the Four Seasons at 10 Trinity Square, the Ned, an independent hotel, the Westin, London Queensbridge. We'll see the Canopy by Hilton make its debut in the market for those millennials. City of Westminster, it's got a high base already, but it's going to see 6% growth. Great Scotland Yard, we're going to see a Steigenberger Hotel in 2018 from the newly named Deutsche Hospitality. We're going to see M Gallery, Leicester Square, so on. Budget is we're going to be going hub-tastic, I think, with 3 hubs by Premier Inn, Soho with 110 rooms, 2 in Westminster, Tothill Street and St James's Park. So there really is a very significant pipeline addition coming to London. Now, you've had to listen to me bang on for probably long enough. I can see some eyelids beginning to sort of sag. And it's time for me, I think, to hook you up with some CBRE friends and experts in their respective fields, because I want to give you some respite, but also to benefit from their thoughts and perspectives on some of the key issues that are likely to shape and impact the hospitality and tourism industry over the coming 12 months. Now, first, I'm going to call on Richard Barkham, who is CBRE's Global Chief Economist, for his insight from around the globe. And first, we're going to track him down in Washington. So, hello, Richard. Are you there?
Hi Dave, I'm here in Washington. I'm staying at the Hay Adams Hotel. It's very expensive, but it's one of my favourite places in the world, and it's where global chief economists hobnob with leading politicians. My CIA chums have made me wear these sunglasses, by the way. In any case, what I want to do is offer you some insights on the US economy for the purpose of our clients. And what I'm finding is that actually things are pretty good in the States. The labour market is tightening, wages are going up, and I think that's going to bring very gently some interest rate rises that will pull up the value of the dollar. All of that prosperity and the value of the dollar, that's very good for tourism. I think we're going to see an upsurge of US tourism into London through 2017. It's going to be a good year.
So, I mean, a pretty upbeat assessment from across the pond, and we should be getting set to welcome increased numbers of our US friends. I just need to pause momentarily to allow Richard to hot-tail it to the other side of the world using his proprietary time and space continuum shifting transport technology that only a man with a PhD could master, all the way to Beijing. So, Richard, have you arrived yet?
Here I am in Beijing, again for the benefit of our clients. I'm staying at the Grand Hyatt Hotel. It's a fabulous hotel and you can get really good Peking duck very nearby. In any case, what do I think about the Chinese economy? It's slowing, the currency is devaluing, but that shouldn't blind us to the opportunity that's here. There's a huge amount of accumulated wealth. The Chinese economy has stabilised somewhat, and I think that bodes well for Chinese tourism into London and the rest of the UK through 2017. You've got to remember that the Chinese are very interested in old cultures, and there's a real hunger to learn about other countries. And I think 2017 is going to be very positive from Chinese tourism, which I think is the biggest growth market in the world.
Well, I heard the other day that Chinese visitors to the UK have pushed into the top 10 for the first time, and their numbers just keep on growing. Now, you're probably getting the sense that Richard is rather partial to hotels and is a wannabe member of the CBRE Hotels team. Now, all folk need to find their thing to help them unwind, and Richard's particular proclivity is to go topless skiing. Now, I can sense some nervousness in the room, but worry not. That was never going to get past the CBRE brand police, was it? So post-content control censorship, using that same transport technology that he used earlier, we're going to see if we can find Richard closer to home. Richard, are you there? Are you decent?
Okay, senoritas and caballeros, ladies and gentlemen, meine Damen und Herren, hey baby from the 17th. Okay.
So I'm here in Kaprun in Austria doing some summer skiing with clients, obviously. And I'm staying at the Sonnenblick Hotel, fabulous place. But what I'm really here for is to take a look at the European economy, which I think late in the day is doing quite well. As employment comes down and gas prices are cheap, there's a feel-good factor entering into the European continent, not been there for a while. So I think that, alongside the fall in the value of sterling. That makes prospects for European tourism into London and beyond very good for 2017. So I expect to see more Europeans jumping on that Eurostar, coming over to London and bargain hunting. And that, I think, finishes my global roundup for you. I wish all our valued clients at the AHC conference a very good year in 2017. I think you're going to have one. I, of course, won't be with you. I'll have been sacked by CBRE for misuse of expenses, but it's been worth it to bring you these insights. I hope you enjoyed them. Bye.
Well, whoever said that economists couldn't have a personality, and I'd like to think you've seen two that have great personalities in the room today. I think it was a generally upbeat assessment from our now former chief economist, Richard Barkham. Now I'm going to enlist the support of Miles Gibson, who's CBRE's head of research. Well, we'll first try and catch up with him in London. So Miles, hello.
Hello Dave, and hello to the AHC conference in Manchester. I just want to say a few words about the state of the UK economy. Actually, it's not too bad. The UK economy, we think, will grow by about 1.8% this year. That's actually faster than the US at 1.5%, so not too bad at all. And the reason for that is that we have some really good fundamentals. We've got high levels of employment in the UK, in fact, record levels. We've got high levels of investment and high levels of consumer spending at the moment, off the back of real wage growth. We've also got low interest rates, low inflation and low oil prices. So really quite a lot going for us as we go into 2017. Admittedly, there will be a slight weakening because of the Brexit effect. Uncertainty is generating a lack of confidence, but there are upsides too. So the Brexit effect for the hotel sector and for tourism is dominated by the currency effect, where we've seen the pound depreciate against both the euro and the dollar by about 9 or 10%, which has attracted extra visitors into the UK. Looking slightly further longer term, we are of course waiting for more information about how migration and trade might work when we're outside the EU, and that matters for hotel and tourism industries because of course tourists may need visas. We're still waiting to find out how the border control will work. Will there be any fresh irritations for travellers there? But also, what about the hotels and tourism workforce? 27% of those working in the accommodation sector are foreign-born. That's quite a big proportion. If those people are not allowed to either stay or come to the UK, then we may have wage inflation there, feeding through into profits in the sector. And then we need to wait for quite some time before we will know how the Brexit politics will work out, and there are many unknowns there, which we will have to wait for some months, we think, to be resolved.
Thank you, Miles. You might have heard his mum trying to reach him on the payphone throughout that. Right, now we're going to catch up with Miles again with a video post he made from Birmingham last week.
So we were hoping that the Tory party conference here in Birmingham would shed some light on those uncertainties, but unfortunately we got more heat than light. And attention now moves to the autumn statement on the 23rd of November, when Philip Hammond, the Chancellor, will be able to give us his take on what Brexit means. And we're hoping that he may provide a bit of extra fiscal stimulus into the system with some tax cuts, which might help the hotels and tourism sector in particular. Either way, we'll be monitoring the political developments over the next months and years from here at CBRE, and we'll keep you in touch with our programme of regular research. Back to you, David Madison.
So all attention on the autumn statement, it seems. I think if Philip Hammond gives the economy a fiscal stimulus in the form of tax cuts, it's got to be good news for our sector. Now we're going to get some insight from Jane Lees, who's CBRE Hotels EMEA Head of Hotel Valuations, who we hope to catch up with fresh back from the continent. Jane.
Thanks, David. And hi, I've just jumped off the Eurostar from Paris. So what's going on in that city? Not great for the hotel market at the moment. The terrorist attacks have obviously impacted both trading and investor sentiment. It's mainly a domestic investor market at the moment. On a more positive note, turning to Germany, Olivia, who's head of our hotels team in Germany, tells us that there's continued and strong underlying demand from both the domestic and international markets for German hotels. Values are remaining strong and improving at the moment. What may impact the market is obviously a lack of stock coming to the market. Turning closer to home, looking at London and fixed income investments, strong demand still for those, and we see cap rates at around 4%. The operational market, a slightly different story. Obviously, we've seen a softening in trade, and whilst values have continued to hold, that's really been down to cap rates and the strong underlying demand from both the overseas and domestic market, making London an expensive place to invest. Do we have any concerns for the UK hotel market? Probably we do within the secondary and tertiary markets, where some of those portfolios which have been bought and sold over the last couple of years will start to be churned. We'll see that weaker stock coming to the market. And we may see through that stock coming to the market a softening in values. Although looking at the primary market, we see a more positive story. Looking at Edinburgh, Birmingham, Manchester. So Manchester, where you're sat at the moment, a key global city, strengthening all the time, 7-day-a-week hotel market. And in terms of connectivity, it's great. And I think as London becomes more expensive, we will certainly see both UK and international investors looking at key global cities like Manchester to invest in. We think at the moment that cap values should maintain well, and going into 2017 may see some strengthening as the underlying demand continues. So hopefully that's a good recap for all of you sitting at the Hilton Deansgate on the UK market, and I wish you all a successful conference, and back to you, David.
Thank you, Jane. A comprehensive resume there. I think by some miracle I saw Jane in the audience. Quite how she got here, I don't know, but she'll happily elaborate on any points in the breakout areas. Now, next up is my chum, Rob Seabrook, who's CBRE Hotels UK Head of UK Investment Properties, to give his insight. Now, he's not always an easy chap to find, but here goes. Rob, Bale's here. You okay to talk?
David, thanks very much for the introduction. As you can see, I'm on the golf course again, as usual. Hi there. Hello AHC, hope you're all having a great time. As Bale's mentioned, I'm here to talk about the investment market for 2017. Good news for all the agents in the room. I think we're going to see an increase in the volume of sales, mostly driven by the regional market. London remains the place where high net worth, wealth preservation pervades, and it's not really a financial return that the guys are looking for there. But the regional market is showing some good value, and we can definitely see that improving. With regard to the buyer audience, predominantly franchisees in the regional UK market, both domestic and also Asian. We should see some high quality assets coming through in 2017, and I can see some Middle Eastern and Asian interest particularly pursuing that. Generally good improvement with regard to the market, I would say. Stabilisation is going to give the opportunity to bring some new cash sources into the market, institutions hopefully, but also some high net worth money. With the lack of other alternative investments, I'm anticipating that they'll be backing some of the more experienced investment partners and seeing the market improve. So that's over from me. Hope to see you all later. Thanks very much.
Thank you, Rob. Let's hope that didn't spoil his round too much. Now, last and by no means least, I'll call on one further friend. That's Joe Stather, CBRE Head of Hotels Research. And Joe was one of the cyclists that you saw earlier. And such is his commitment to the cause that he wanted to make his contribution from his idyllic holiday location and hometown. So, Joe, please, if you can hear me.
Mr. Bailey, here I am in sunny Scarborough, the pearl of England's east coast, my hometown and Britain's first seaside resort. As you can see this afternoon, a packed beach here behind me, and therefore a fitting location to mention the UK's post-Brexit surge in travel and tourism. Train and coach operators have reported a flood of bookings as Brits choose to holiday in their home nation. Much to the detriment, however, of overseas destinations, including Ireland, where UK tourist spend has fallen by 12% this summer. A whopping 70% of UK adults have been on or are planning a staycation, with the seaside the most popular destination. Nonetheless, our countless towns and cities with their great history and attractions are also in favour. Britons have spent £22.1 billion on holidays at home following the recent drop in the value of the sterling. And the average spend for a staycation has gone up by 38 quid in the last year to £613. Inbound tourism this summer has also jumped by 18%, and tax-free shopping is up 7% as visitors from Asia and North America flock to London, with their currencies going further for the luxury goods in London's shops. Our recently appointed PM Theresa May has announced a £40 million fund for UK tourism projects, recognising the great potential within our industry. All of this news can only be positive in driving short to medium-term demand for our country's hotels. I personally think we have every reason to be optimistic about the year ahead. However, I'm getting burnt to a chip under this late summer sun, so I'm off for a dip, Dave. It's Tara from Yorkshire, and it's back to you on t'other side at Pennines.
Oh, he's a grand lad, our Joe. Not only did he do that on his holidays, but as I say, he cycled all the way here with his band of Lycra brothers and sisters, and I think they all deserve very special praise for that. So look, I've covered a lot. I'm conscious of that. Trying to throw a lot at you in that post-lunch. You've probably forgotten about lunch, hopefully, and give you a broad spectrum of inputs from a very talented pool of folk that we can draw upon back at CBRE. I think whilst there's much to take heart from and be positive about, we do live in incredibly uncertain times. And I see the key UK hotel sector risks being extra rather than intra-sector. I think specifically economic and political, which you've heard a lot about, and probably terrorism is arguably the most clear and present danger, and to the London market in particular. I think with the US presidency election yet to be played out, we face a continued period of political torpor, and Russia is fully capitalizing on this in its barbaric intervention in Syria, seemingly believing it can act at will. I think it's frankly alarming that we appear to be drifting into a Cold War scenario, colder and potentially more dangerous than the last. That said, though, I am a natural optimist, specifically regarding our hotel sector. And in particular, in addition to the underlying fundamentals we've heard of, and from and picking up on what Trevor was saying earlier, I draw particular optimism from the innovation that is evident in the sector. Innovation in new concepts, new hotels, rebooted lobbies, rooftop bars, new room iterations, new business methods, picking up on what Thomas was saying earlier on, and the increased intellectual firepower and capability of the operators and the brands, and much of that firepower assembled here today. Hopefully, we can expect to see innovation from our new Prime Minister and Cabinet in the coming months ahead to March 2017 too, as we chart a new course for the UK. We'll certainly need it. I think it won't be so far away that we arrive at our hotels in driverless cars. I read today they were publicly tested on the roads of Milton Keynes yesterday, and people were oblivious to these computer-controlled cars. And they're going to be tested on motorways next year. We'll be greeted in hotels by artificial intelligence androids and virtual butlers. And as we look forward, it really is, I think, very much a case of watch this space for the next few years and beyond. I think to paraphrase our new Prime Minister, and I think to nick one of Bob Dylan's best lines, the times, they are a-changin'. Until next year, thank you, and enjoy the rest of your AHC.